Welcome, everyone. My name is Brian Hartstein. I'm here with my partner, Andrew Raffel, with Bayntree Wealth Advisors. We do the advisory work and help support the 401k plan for Cell Eugenics. And as participants and employees of Cell Eugenics, we thought we'd put together sort of an impromptu webinar beyond what we normally do for the general education components, because there's a topic that we feel is extremely important to address when we're working with 401k participants, and that's on risk tolerance and asset allocation. So I'm going to go through part of a webinar that I actually gave previously just to highlight some parts of risk tolerance, different background pieces, what we feel is important, and then Andrew is actually going to walk through one of the diagnostic tools that we utilize here that helps individuals assess their own personal risk tolerance and use that to help them construct what we feel is proper portfolio allocation or construct the proper investments inside their 401k account. So one of the things I do want to highlight that's on the screen right now is this is the Bayntree team, our team here that's dedicated specifically to working with your plan. You may already know a few of these people, but I wanted to introduce everybody. You've got myself, Brian, and Andrew. You've got Chris Roger. Chris Roger is an advisor who's specifically dedicated to working with you, an employee and participant in the Cell Eugenics 401k plan. He's available anytime you need him to answer either questions specific to the 401k account, the plan, or maybe you just have general financial planning related questions and how other investments you have may relate to your 401k account or just planning in general. And then we have Rena Blanco, who you may talk to. She kind of coordinates all aspects of the plan and works with your HR team, and Megan Shai as well. And one of the things we always like to tell people is part of our role here is to help support you. There's no cost for utilizing us and our services to be able to help you with any questions you may have, planning you may need, or anything related to the plan or just planning in general. That's what we're here to do, and that's how we're here to service you. So one of the things, we go through some different pieces on risk tolerance. One of the most important pieces of that is determining risk, and that's really what we want to focus on today. But we always feel that when we talk to people about risk tolerance, we've now seen 8, possibly 9 years of what we call a bull market, meaning the market's been very strong since we went through that somewhat recessionary period back in 2008. So it's usually very easy for someone to have a lot of risk tolerance when the markets are good because they forget what it was like when the markets were down. So even though we love assessing risk tolerance today, we always feel it's important to go back maybe every 1 or 2 years and reassess your risk tolerance, because not only will you become older, your needs may change, your family may change, your lifestyle may change, but markets change. And how you feel about risk and how you feel about the markets will change as well. So just like you go to the doctor once or twice a year or once every couple of years to get an annual medical checkup, we always urge clients to go back and reassess your risk tolerance once every year or two, because again, that could change just like your health will change. So when we're looking, we're going to flip through this. Again, some general rules of thumb, but there's always exceptions to these rules. Again, if you're younger, obviously looking at more of a longer time horizon. And if an example of that is if you use the target date portfolios inside the 401k's investments, those are geared towards people retiring in 5-year increments. So for example, if you're going to retire in 20 years, let's say 2040, you'll have investments that are built for somebody that's going to retire in 20 years, which are probably going to be more aggressive than if you retired in 10 years. And over time, those will get more conservative. So again, younger investor, longer time horizon, older investor, shorter time horizon, and that definitely factors into risk. But again, there's considerations and exception to the rules. Again, you have to look at your investment objectives, and what we feel is very important is level of investment experience. Inside the 401k, it's really built for 2 types of people. What we call the do-it-yourselfers, the ones who love investing, that want to do their own research and want to build their own portfolios. And there's an incredible amount of individual investment options across all of the different types of investments, whether they're large cap value, international, where you could build your own portfolio. But if you're not real experienced, or if you want the professionals at John Hancock to do it for you, there are pre-built portfolios, either based on your date you might retire, or based on just level of risk tolerance, such as aggressive or balanced, that they will professionally manage for you, and there's no additional cost for them doing so. So whether you are do-it-yourselfer or you want some help, There's no additional cost, and you can have that built appropriately inside the 401k. Again, how do we determine risk? When you look at your John Hancock plan, everything's color-coded. So that if you're looking at something that's red or orange or yellow, you're probably in a more aggressive, a hot area. If you're looking at something that's green or blue, it's cool, meaning the risk is lower. So even if you don't have a really good idea of what maybe an investment means when you're reading about it, as long as you can see the color, you'll have a good idea of where it falls. And again, the higher the risk of a particular investment, the higher the possible return. Conversely, the lower the risk, the lower the possible return. So when we're building portfolios, we're usually trying to incorporate different pieces along this spectrum to create the right portfolio for somebody. And that's what we're here to do. So if you want to do it on your own, that's great. But again, we're here to show you how we usually help individuals and participants build it on their own. They usually call us. They say, can you help us walk through some of this part? And that's what we do. Again, so this is kind of just a different way to look at risk with investments. Again, the really risky ones on the top, the really conservative ones on the bottom. Okay. This has to do a little bit with dollar cost averaging, but I kind of hit the high points of what we feel about risk tolerance. What I'd like Andrew to do at this point is walk through one of the diagnostic tools that we utilize here. It's not part of John Hancock. John Hancock has great tools on their website in which you can use for education and to determine risk tolerance, but we use this tool here for our own planning with our own clients as well as 401k participants in addition to what John Hancock does. So if you would like access to this, you would like somebody to walk you through this and do this for you individually, please call us. You'll probably get Rena, but ask for Chris. Chris can walk you through this part of our diagnostic process and also answer any other questions that help you along the way. So Andrew, I'm going to turn it over to you.
Thank you, Brian. So, as technology's advanced over the last decade or so, it's really helped us on the financial aspect of helping each other and our clients understand how they feel about risk emotionally, how the risk-reward spectrum fits into their overall retirement plan. And part of what we'll show you today is the assessment that we can have you walk through, whether it be with us or you utilize the link and do it on your own. But what this software does, and it's called Riskalyze, is it's going to give us an emotional output of how you actually feel about risk at this time or this stage of your career. And one of the areas is we look at that risk number, 100 being the most risk, 0 being the least risk. And then ultimately, when we get that emotional or that risk fingerprint, then the neat part of the software that we'll show you is we can take you through your current portfolio, whether it be with John Hancock and or outside investments that you're managing or old 401ks, and kind of correlate that all together so you can get a clear picture of where you are, what the risk reward is. As Brian mentioned, we are 8.5, 9 years into this bull run. We're not saying it's pending doom and gloom tomorrow, but it's definitely wise for you to take a full financial look at where you've been and if you should make changes. This helps to answer some of that. So what we're going to do is walk you through quickly how this works. And again, our team here can help you go through this, or you can do it on your own. We'll send to you, if you email us or call us, the link. And it's also on our website at Bayntree.com. So some of the things that clients, depending upon where you are at the stage of life, a goal could be retirement, accumulating wealth, and maybe paying down debt. So obviously it's going to be different for each and every one of you. Then you can mark in here what are some of the, status, any inheritances, any major expenses. Are you worried about college funding? So those type of things help as you're building out a goal map of getting you from point A to point B. And also on our side, it helps us with our clients to make sure that we're providing that fiduciary advice and to help them reach those goals. And then year born, so if we look at the year born and then the retirement age, I know we don't know exactly, especially as we're working, when we're going to retire. So this doesn't have to be a hard fact, but just kind of think in your mind of when you think you're going to retire, because that will help project out to that risk spectrum. And then how much to invest. Again, it doesn't really at this case definitively matter if you put a hard number down, but put something in that context that relates to whether it be just your 401k or all of your outside assets. In this case, we're going to just use $250,000. So this right now, what it's going to show us, and this is our simple questionnaire. If you do call us, we have a more detailed questionnaire that our team will walk you through. That's about 10 questions. But in this case, what we would look at is when you kind of feel that comfort level right now of your overall portfolio, where would you be comfortable in looking at that risk reward? So as you can see, the higher the risk, the bigger the reward, but obviously the more risk you take, the higher beta type of mutual funds or stocks, the more you have to look at what the downside is. What is what we call in that standpoint, a couple factors, standard deviation, but what could be the max drawdown? So in this case, if you use our guideline here and you say, okay, I'm comfortable with kind of more of not so much the gain, but what's your comfort level and how much you're willing to risk losing in a 6-month time frame. And as Brian mentioned, if you have a long horizon, you can come back from that, but the key is as you're getting closer, or what we call climbing the retirement mountain, it gets harder and harder to come back from that. So let's say in this example, this sample client is comfortable with the 12% downside, and in this case, a chance to gain 12%. So then it'll go into some more detailed questions. Here's our original choice on the $250,000. So when you think about that, that 12% in real numbers is a $30,000 loss. So you may look at that and say, you know what, I'd rather take a little bit less risk, and if I can have less risk and keep my return the same, well, that makes more sense. Or you could look at it and say, you know what, I'm comfortable with that 12% loss, but what if my gain was a little bit higher? So you look at that and say, well, you know, this more reward makes more sense. So then you would click on that, and then ultimately you can make the decision even more risk, which would bump up your downside of your max drawdown. So let's say you look at both options here and you say, I'm comfortable with where I am here. And then ultimately the last choice, which we had the plus 19 to the minus 12. And then when you look at that and say, well, if I can have a little bit more gain, and I know my risk is a little bit higher there in the 13%, and you say, I may feel comfortable there. So what this is going to do is provide us that snapshot of how you feel about risk. And it's not going to be perfect, but in this case, somebody who's working, they're looking at the real comfort level for them is, instead of 12 and 12, is, well, maximizing that return, risk-adjusted return, having a comfort zone of a 20% upside and a 13% downside, and thus a 63 risk number. And in this situation, we'd say, yes, that feels like me. We can click on that. And then what I'm going to do is bring in for us an example of this client. And what we did here is, now that we have the update of their risk number, as you'll see here, that the client verified 63, what we did here is we put a sample in of a client that had a multitude of portfolios. And what the neat part of this technology does is it pulls in the different positions of that portfolio based on historics of the historical returns, the risk-adjusted returns, and what's underlying the investments within the mutual funds or ETF. So you can see in this model 400, this is a 48 risk. And then what's neat about it too is that we can drill down at the level and see exactly what's going on in this ETF. This one, for instance, iDog, is a dividend investment that is focused on the international sector, and it's going to give worst case, best case. So what our team can do is help you analyze all of your current positions. Here's another example of another account that has a little bit less risk. The risk is 28. Then we've got a passive portfolio here of Vanguard funds that's going to have even a little bit more risk in that context. And then we have one that's going to have the most risk. So overall, you may have 5, 6, 7 accounts out there. And one of the key factors in trying to determine what you're going to invest the 401k in is that we have to look at the whole spectrum. And that allows us as planners to provide good advice to you. And it's something that we at Bayntree, a complimentary service, would be able to help guide you through that, rather than just looking and pigeonholing on one account. It's much easier for you to make good decisions when you understand exactly what you have in all accounts.
Right, and you can take, what we would do here and specific to the 401k plan is, once you have an idea of your risk and your risk number, then we can look at the different investment options inside the plan, and Chris can certainly help you tailor to your risk level what your account should look like and how to mimic that, so that you're not taking too much risk, but you're not taking too little risk either, so that would eventually, when you get to the point when you're done retiring, you've been efficient with how you've been managing your portfolio. So this is just one example. Again, and what Andrew walked you through is more of the simplistic version, which I think you can access on our website. But if you call us, we can also walk you through a more in-depth version. It just depends on how hands-on you want to be. But just wanted to give an example of how important risk is when making investment allocation decisions, whether inside a 401k or outside a 401k, and to show you some of the things that we can help you with if that's something you do want help with. So,
and then with what we can do, if we are running an analysis of the portfolio, we can provide you a detailed report of everything, of your current positions, of potentially what the proposed model would look like. And when we look at risk reward, it's just understanding from your side the risk you're going to take, the rewards you're going to have, and understanding where that's going to fit in emotionally and in general with your overall retirement plan.
Right. So, Andrew, would you mind putting on the PowerPoint, put up the last page so they can see that? So this will give you an idea. Obviously, if you want to, on that last page, it'll give you the link that if you want to access the John Hancock quiz, you can. But if you want to go to our website and start looking at some of this software, it gives you the link as well. And if you need to call us, our local number is 480-494-2750. Just ask for Rena or for Chris, and they can help you walk, with any questions you might need answered or any help that we can possibly give. We're here to help support you as the employee and the participant of Solugenics. So please let us know how we can do that in the future. If you want to, if you're out of state and you want to call our 800 number, you can do 888-255-3200.
And then you'll see right here on the bottom of the website on every page is the actual link to the risk number as well. So you could just go to this banner and click on that, and then that will pull up the specific questionnaire for you. You'd put in just a little bit of information about yourself, and then you would go through that questionnaire, and then we would be able to work with you on that. So really great technology. We're going to continue at Bayntree as technology advances. We're going to continue incorporating that in to help you guys make sound financial decisions. We appreciate the time. We're always here for you. Have a wonderful week, everybody.
Thanks again.